Bankless Nation, we've got another segment for you. Something special today, something different, something I guess we need to talk about. We had a regular State of the Nation planned, but events overtook it once again. It's been the story of the last 3 weeks. I think what people want to know in today's episode is what's happening with Genesis, this large institutional crypto lender. Is this the next domino to fall? If that happens, what happens next? And then higher level, as David was pitching me this episode, I don't know if you guys have ever seen that picture of Charlie from Always Sunny in Philadelphia. And he's got like, let me share the picture as I'm talking. He's like in front of some kind of a board, like a half crazed detective. This is David coming into this episode.
Yeah.
All right. Because I think, David, you feel like this has linked, this last series of events with Genesis has linked a whole series of things in your mind and is helpful to explaining, and you for you to explain what happened
Everything.
the last 2 years in crypto.
Everything.
I mean, the question is, like, I'm coming to this episode and David's like, yo, I think the last 2 years, solid 12 to 18 months at least, have been a ginormous Ponzi game.
Dude, the whole 2021 bull market was a gigantic Ponzi scheme. And
can you make the Charlie face? You got a cigarette?
The whole thing, dude.
What's going on a thumbnail?
The whole thing. The whole thing was a Ponzi scheme, and now we're at the end. It's completely unraveled, and now we're at the final conclusion. And so I was going to make a show about, all right, is Genesis insolvent? What's going on with Greyscale? What's going on with Barry Silbert and Digital Currency Group? And like answering that question, what's going on in the last 7 days has been the final puzzle piece that fits over the broad category of 2022. Contagion. Why was there so much contagion? We now know. We have all the answers.
The good news. I think we have all of the answers in today's episode. If you had any question coming to today's episode, you'll leave with the answer to your question. But really, I think this is, we're going to walk through it. We're going to end with the last domino. We hope is one of the last dominoes to fall, which is Genesis, Digital Currency Group. What's going on with kind of, it even ties into retail products like Gemini Earn. People still have funds stuck on that. What's going to happen to all that? We end with that. But in order to explain that, we're going to take you through 2021, 2022, and the series of dominoes that led to this final domino falling. So this is going to be an interesting episode. And guys, I just got to, like, I looked over some of David's notes real quick coming into this, but at some level, I'm along for the ride with you too. All right. Because I think David's going to unpack his brain, and I'm just here asking questions. Before we get in, I want to tell you about our friends and sponsors at Consensus, more specifically at Infura. If we're going to rebuild crypto, which we absolutely are going to do, we have to build it on decentralized infrastructure. And Infura is an Ethereum infrastructure provider that is doing God's work to make sure that all of our DeFi tools load in the pages and in the ways they're supposed to load. They are taking steps to further decentralize this infrastructure as well. And they wanted us to let you know that there's an opportunity to find out more about what they're doing. David, take it from here. What does Infura want to communicate to the Bankless Nation?
Yeah, so Infura has been this critical infrastructure provider for all of Ethereum. Like running a node, if you just want to easily build something, you would just plug into Infura in order to access Ethereum. Well, they themselves want to decentralize their own stack. So they want you to help them foster a brand new decentralized infrastructure ecosystem. And so we can get this journey done. We need all these people. We need more people to come and help Infura in this role of decentralizing themselves. So there is a link in the show notes so you can plug into the Infura stack as an independent infrastructure provider so we can decentralize a core piece of Ethereum.
Good stuff there. All right, let's talk about the high level of the episode that we're about to get into, kind of the daisy chain of events. And I'm going to bring up a tweet from Barry Silbert, who's kind of, I guess, the first player in this story, but also one of the last players in this story. Why did you want us to look at this tweet? And this is from June 24th, 2021, a tweet from Barry Silbert, who, of course, we'll introduce the actors in a little bit, but he is the leader of Digital Currency Group, Genesis, what else, David? I guess I'm going to bring the GDBC and the ETH trusts that people can buy in their retirement accounts. What is Barry saying here, and why is this relevant to the story?
Yeah, so this was June 24th, 2021, which, if you remember, was this first big crash in crypto after a meteoric rise of basically all crypto asset prices. Ether hit $4,300, Bitcoin hit like $60,000, and then in 1 or 2 days, we lost like 50 to 60% of the crypto market cap. And then, as the dust settled, the bull market actually resumed. Again, this was in the middle of 2021, and Barry Silbert tweets out, "There is a daisy chain of borrowers and lenders in the crypto space, most well capitalized, but some are not. Lots of leverage still in the ecosystem, including in some non-obvious places. Important to understand counterparty risk and where the weak links are in the chain." Now, this tweet was like was the indication of all things to come over the next
it's foreshadowing
12 to 18 months.
In our Shakespearean tragedy story, this is a foreshadowing.
This is foreshadowing. This was the tweet to pay attention to at this moment. No one really knew how to unpack these things because all of these were centralized lenders, so it's a black box, so we didn't have that information. But this tweet became true in fantastic fashion, and the irony, Ryan, is that Barry Silbert tweeted it, and that daisy chain of borrowers and lenders has come full circle back to his own trading desk, Genesis, which is part of his company, Digital Currency Group.
Okay.
The full circle nature of this story is absolutely insane.
Back to Barry. This is where the story starts. This is where it's actually going to end when we get into it. I'm going to pull out a few phrases here. Daisy chain of borrowers and lenders. He says, most well capitalized, some aren't. Lots of leverage, he says. Important to understand counterparty risk and where the weak links are in the chain. What do we have here, David? This is a diagram I think you put together for this episode, and maybe is kind of the different sections. All of these layers maybe represent dominoes. Explain this for us.
Okay, so I stayed up like late last night because I was going down this rabbit hole. So I made this pyramid. Brian,
happy Thanksgiving, by the way.
This was the 2021 bull market. Okay. So like the 2017 bull market was determined by ICOs printing tokens out of thin air to fundraise, and they would buy Ether and USDC and it was a bunch of printing tokens out of thin air, and that's what the ICO mania was. I regret to inform you, Ryan, that the 2021 bull market was the same damn thing. We had these yield farming, DeFi yield farming, pool twos. Remember pool twos with like 500% APYs if you were like willing to take the risk of like other yield farmers to dump on you. So like pool twos with incentivized APYs, and farmers would play chicken after like everyone would want it to farm. And that was like, crazy 100 to 1,000% APYs. That rested on top of the pool ones, where it was lower risk. You weren't providing liquidity. You were just incentivized to stake your tokens, whether it's like whatever DeFi yield farm. You would just stake your tokens and you get a yield. You didn't really have to have as much risk. Moderate 10 to 90% APYs. That was the top of the pyramid. That was
DeFi Summer.
That was DeFi Summer, and also like that. And then Solana, Avalanche, Phantom. That was their game as well after Ethereum took it over.
Okay, hold on. You're saying top of the pyramid, but actually, the way you're describing it, I almost think that this pyramid should be flipped on its head. Do you know what I mean? Like, so the top should be kind of the weakest part, but that's where it really starts, right? It's like pool twos and pool ones. The DeFi Summer is actually kind of like the start of the pyramid and what the full 2021 bull market builds into. Is that right?
Sure. It depends on your perspective.
Okay.
What we are looking at here is a risk spectrum as well, where if you are at the top of the pyramid, you are on the highest end of the risk curve. You are the things with the most APYs, with the most risk, and then the risk actually gets lower as you go down, which is why...
The perceived risk gets lower?
No, the real risk. Like, it's just like... This is why people are concerned about Genesis and Digital Currency Group, because they are the foundation of all yield. All that yield, all that crazy speculation, all fell down at the end of the day to Genesis. And that's why we are talking about Genesis today, and why I feel confident that this is like the last big domino to fall. Okay? So pool twos and DeFi yield farms were supported by pool ones. Pool ones, which were the basic yield farm, that's where Alameda and Three Arrows Capital got a lot of their money in the second half of the bull market. Hedge funds maxed out lines of credit from anyone that would allow them to borrow from them. This is what Alameda and Three Arrows Capital did, and this is where so much Contagion came from, because Three Arrows Capital and Alameda borrowed from as many different lending desks as possible. BlockFi, Voyager, Celsius. And then when Three Arrows Capital and Alameda went under, they took all the lending desks with them, except for Alameda and FTX found a way to print a bunch of FTT to support all the lending desks. But ultimately, all of that money, all the capital to BlockFi, Voyager, Celsius, where were they getting their yield? They were getting their yield from Genesis, the GBTC Arbitrage, and ultimately the whole entire digital currency group system. And that, Ryan, was the 2021 bull market. All of these high risk yield farms ultimately was supported by the largest player in the game, which was Genesis, and also the arbitrage for the Greyscale premium.
So you're telling me everything that happened in 2021, all of the price appreciation that we've now, by the way, walked back and reset, was just smoke and mirrors, was almost like a Ponzi scheme of stacking risk and stacking like interest that wasn't really real?
Yes. And it was all in the whole reason why this whole thing worked was because we were able to print tokens out of thin air, which is the way that every single crypto bull run has gone since its genesis. So like you want to go to and click on that tweet. You know, remember this tweet that caused a bunch of like crypto Twitter murmurings, because this was the one that like Richard Hart responded to. And Richard Hart, like I tweeted out, okay, Three Arrows Capital is insolvent, Alameda is liquidated, FTX is insolvent. If all these people are insolvent, I asked then who made all the money? Richard Hart comes in like, hello there, it was me. Well, it wasn't him, Ryan. The actual answer is the next tweet. The actual answer is this guy who used this illustration of a neighborhood with 100 houses and has one sale for $1 million. Therefore, the collective houses are worth $100 million. But then the remaining 99 houses only sell for like 10% of that. So actually, like $91 million of equity is actually gone. This is what happens when all these illiquid shitcoins, all the DeFi yield farming, all of the degeneracy high APY pool 1 and pool 2s, when all of those tokens go down in price, the entire system gets wiped out because of all of the systemic risk that got built up by players like Three Arrows Capital and Alameda. And so that's what happened, Ryan. That's where the money went. We printed all these Bitcoins, and then they went to zero.
The money was just not real. It was just
money was not real.
Fabrication. It was just numbers on a page. And there may have been some people, by the way, that cashed out close to the top based on those valuations.
Sure.
Some few people walked away with some amount of money. But what you're saying is the price of
they walked away with Bitcoin, Ether, USDC.
Yeah.
Blah, blah, blah. Yeah.
The real monies, like hard monies.
Yes.
And left everyone else kind of holding the bag, and that's where we are.
Yep.
So now here we are. Genesis has what's reported to be like a $1 billion hole. People are now worried about the solvency of Greyscale and digital currency group Empire. We're going to talk about that. And when we get back, David, I want you to walk us through this whole story, if you could. I think we just saw the preamble, if you will. And I think what we're going to go through is show you domino by domino how these pieces were stacked and what caused what caused their fall and what's going to happen next. So guys, stick with us. We'll be right back. But first, we want to tell you about the fantastic sponsors that made this episode possible.
ARBITRUM 1 is pioneering the world of secure Ethereum scalability and is continuing to accelerate the Web3 landscape. Hundreds of projects have already deployed on ARBITRUM 1, producing flourishing DeFi and NFT ecosystems. With the recent addition of ARBITRUM Nova, gaming and social dApps like Reddit are also now calling ARBITRUM home. Both ARBITRUM 1 and Nova leverage the security and decentralization of Ethereum and provide a builder experience that's intuitive, familiar, and fully EVM compatible. On ARBITRUM, both builders and users will experience faster transaction speeds with significantly lower gas fees. With ARBITRUM's recent migration to ARBITRUM Nitro, it's also now 10 times faster than before. Visit arbitrum.io, where you can join the community, dive into the developer docs, bridge your assets, and start building your first dApp. With ARBITRUM, experience Web3 development the way it was meant to be: secure, fast, cheap, and friction-free. The Brave Wallet is your secure multi-chain on-ramp into Web3, and it's built directly into the Brave privacy browser. Gone are the days of managing multiple wallet extensions that put you at risk of phishing, spoofs, and tracking. With the Brave Wallet, you can securely manage your crypto assets across more than 100 different chains, including Ethereum, Layer 2s, Solana, and more, all without downloading risky extensions. The Brave wallet is easy to set up and removes the headache of jumping between wallets and extensions. It's lightweight, but packed with great features, like built-in token swaps, buying and holding NFTs with a gallery view, and support for hardware wallets. But also much more than that, because Brave is shipping new features every single month, with a mission to make Web3 easier to navigate for its over 55 million users. Wallet extensions are a thing of the past, so get started with Brave's Web3-ready browser today and experience a decentralized web seamlessly without all the clutter. You can download the browser at brave.com/bankless and click the wallet icon to get started. If you've been listening to Bankless, you know that we're fans of the modular blockchain thesis. The idea that blockchains will separate execution from data availability and consensus, allowing all three to become the best versions of themselves. And Fuel has built the fastest modular execution layer in the industry. By supporting parallel transaction execution, Fuel unlocks significantly faster throughput for the Web3 world. Fuel also goes beyond the limitations of the EVM with its own Fuel VM, which is more efficient and optimized, opening up the design space for developers. And lastly, Fuel brings a powerful developer experience with its own domain-specific language, Sway, and a supportive toolchain called Fork. With Fuel, you can have the benefits of smart contract languages like Solidity while adopting the improvements made by the Rust tooling ecosystem, letting the Fuel development environment go beyond the limitations of the EVM. If you want to learn more, there's a link in the show notes to see how you can get involved with the Fuel network.
Was the 2021 bull market just a gigantic Ponzi scheme in crypto? That is the central question we're raising in today's episode. And David has brought some of the receipts, going to take us through the timeline here. All the way back in January 2021, when this Shakespearean tragedy started to first unfold. I think in order to set this story up, David, and do it justice, we should do a couple of things. First, we should set the stage where we were in January 2021, the feeling of the market, the prices, that sort of thing. And then we should talk about the key players. As any good, I guess, tragedy does, we have to lay out the background and the actors and the players, the characters that are going to be in this, that are somewhat reoccurring as well. So let's talk about where we were. And I remember it actually coming out of December 2020. ETH was low in December 2020. Remember we had a like show
$400
that was
to $700 in December.
$400 to $700. We had a show that was kind of like the bull case for ETH. And what was really interesting is DeFi had its moment back the previous summer. This was a summer that came to be known as DeFi summer. This is summer of 2021, where people realized that DeFi tokens were real things. Previous to that, all tokens were kind of dead. There was Bitcoin and there was a little bit of ETH, but then all of the other tokens, nothing mattered. DeFi summer 2020 showed people that no tokens did matter, and talk about yield farming, that sort of thing. But ETH was still kind of lingering in the 400s. Bitcoin had seen a moment, and there was this move of to say, all we need is Bitcoin and DeFi tokens, and there's no real use case for ETH. So ETH had not yet popped at the end of December 2020. So take us back to that feeling as we start this story in December and January 2021. What had the market done with DeFi? What was the price of Bitcoin? What was the price of ETH?
Yeah, so at the time, DeFi Summer, Compound really announced the governance token. And that was the new primitive that everyone was super stoked about. This is how we're going to decentralize ownership and control over these systems to as many people as possible. And that was the shiny new object that really anchored DeFi Summer and the concept of yield farming to begin with. And like I said at the beginning, yield farming, liquidity mining was this era's ICO. And before the ICO era, there was the proof of work fork and fair launch phenomenon, which like almost zero tokens made it through. So like we had the 2013 bull market was the proof of work fork and fair launch. We just made a bunch of tokens. 2017 bull market was the ICO mania, where we just made a bunch of tokens. The 2021 bull market, Ryan, was the DeFi yield farming era, where we made a bunch of tokens, this time with yield. This was the thing. Yield was the thing that identified the 2021 bull market, not just at the very high risk end of the spectrum, but down all the way into how regular institutions got involved in crypto, and why they got involved is because there was demand to borrow assets. And this is the story of how everything got built up and how everything fell apart. So if we're injecting ourselves into this story in January of 2021, which is kind of when the story starts, Ether began January at about $900. It ended January at $1,700.
Wow.
Bitcoin started January around $25,000. It ended that January somewhere around $35,000 to $40,000. And so it's on. The bull market is on.
2021, people felt like the bull market was fully on, and they were also hungry. I feel like maybe like we could start to inject terms like greedy. And they were certainly hungry for more yield. Right? Things were frothy. Like, oh, let's do that 2020 DeFi summer thing again.
That felt great. Let's do it all over again.
Yeah. And this starts to inject, I think, this idea that we've seen in many cycles, David, is the concept of a metaphor. We call it the euthanasia roller coaster. This is a picture of the euthanasia roller coaster. And it's a theoretical construct, but the physics of it would actually work. And basically, you start the roller coaster, and by the end of it, after all of the loops, you're kind of dead.
Yeah.
Like it's just been a one-way ride. There's no life left in you. But each of these loops, like describe this in some more detail, and where's the analogy fit? Because we've seen this in previous cycles as well.
Yeah. So again, proof of work, fork and fair launch. What happened? Charlie Lee made Litecoin by forking Bitcoin, and that created like $1 billion in market cap. People saw that and they did that on repeat. They did that over again. And all of a sudden, another loop. Like, oh, that worked for Charlie with Litecoin. Let's make 17 other forks. And then let's make 17 forks of that fork. Eventually, it created a mania. And then eventually people got fatigued and people just got done. And so they left the bull market. Same thing with ICOs. What was the great big ICO that triggered the 2015 ICO mania? It was the 2015 Ethereum ICO, followed by the very successful 2016 Augur ICO. And all of a sudden, people realized that they could do ICOs to mint tokens, and that would generate a bunch of hype, and that's how you could do things. So it started off legit. It ended in tragedy. And so as the ICO mania went on, the loops got faster and faster and faster until people just got fatigued. These things were just way too scammy. Retail investors just lost all their money, and no new inflows of money came into the system. And then we had a bear market. This was, of course, DeFi summer. The first OG yield farm, the first liquidity mining event was Compound, followed by every other DeFi app that had yet to issue a token, followed by copycats on Ethereum. Think about SushiSwap, which, I mean, allegedly was Sam Bankman-Fried. And then we had Avalanche, Solana, Phantom, all of these Ethereum killers show up and then start doing yield farms on their chains. And eventually, people got fatigued. People stopped making money, and the energy ran out of the system. But this is the pattern of every single bull market so far.
The first few loops in the euthanasia roller coaster are fun, and the last couple actually kill you.
Yep, that's right.
That's how all bull cycles end, including this one. So we're going to talk about some of those loops. But as we get into this, the other thing to introduce is, I think, the players here, the reoccurring actors that are important. I want to talk about a few of them. First is the House of Barry Silbert. Okay, this is like the Montagues and the Capulets, right? In their Shakespearean tragedy, the House of Barry Silbert. So Barry has been a crypto OG from the very beginning of crypto. I don't know, he might have been in crypto as long as like Eric Voorhees and people like this. Early Bitcoin holder for sure, but he decided to go the institutional route behind things. So he formed this company called Digital Currency Group. There's a group within that called Genesis, which maybe you can explain some details. Also Greyscale, which is a trust type product. Maybe you can explain that to us. And there are some other products he owned, including media. So like CoinDesk is actually owned by Digital Currency Group. So talk about the House of Silbert. And who is Greyscale and who is Genesis?
So Greyscale is this trust that what allowed people to have Bitcoin exposure on the traditional stock market. If you didn't want to go and set up an exchange that maybe you didn't trust, maybe Coinbase is too sketchy for you because you are an institutional investor, you could just buy exposure to Bitcoin via the Greyscale Bitcoin Trust. The thing is, it doesn't trade one for one. And so the GBTC share on the traditional stock markets are subject to market forces in the same way all assets are. Even though that they are backed by Bitcoin, they do not represent a one-to-one redeemable share for Bitcoin. Why not? Because we aren't able to have a Bitcoin ETF. An ETF would have solved this problem, but we don't have one of those, so we have to have the next best thing, which is a Greyscale trust. There's the BTC trust, there's the Ether trust, there's a few other trusts, but the Bitcoin and Ether are the very big ones. So that's Greyscale. that is owned and operated by Digital Currency Group, which is where Barry Silbert started. Also, part of Digital Currency Group is Genesis, and Genesis is crypto's only like full-service prime brokerage. What is a brokerage? It's a custodian. It's an OTC desk. It's a lending desk. It's basically all financial services all under one roof.
It's like a Fidelity account or an E-Trade account or Charles Schwab account, except for big institutions, not for everyday users, not for mom and pops, not for retail, but for big institutions. It performs all of those services.
Yes, correct. And so these are the two big players. The CoinDesk is also related here because they were actually the ones that published that Alameda report. But not really a key player here. But that's the house of Barry Silbert. That's the house of Digital Currency Group. Ryan, this story starts there. It also ends there because that is where the Contagion has finally come home to roost, back to where this whole thing began. But we'll get into how it began in a second, because how it began was some players in this game. The next house we're going to talk about are the house of the hedge funds. Three Arrows Capital, Alameda, both came into fame in 2019, 2020. And these are the people that spread out all of the Contagion. They are the things that connect everything because of how this bull market progressed. They ultimately borrowed from whoever they could get their hands on money, that wherever they could get their money from, they would borrow and borrow and borrow. And they are the middlemen of all the Contagion. And so we'll get to that story as well. There's also, of course, the house of Do Kwon and Terra Luna, which probably started the cascade. It was probably the first domino to fall. There's the ETH killers. I think you remember the acronym Solunavax, if you remember that. And then, of course, there's the house of Sam Bankman-Fried, also Alameda, FTX, and all of the Sam coins, FTT, SRM, Solana. And also, Ryan, the last player in this game is the SEC and Gary Gensler, or what they chose to not do rather than do. So these are all the players.
The house of the regulators. These are the cops on the beat. Mm-hmm. Okay, so we've got our players. We've got our background. People hungry for yield, traveling on that euthanasia roller coaster. Take us to Domino 1. Right now, I think what we're going to do is we're going to lay out the major dominoes that haven't fallen yet, but that are being stacked in a row. Yep, and they're being set up right now. So the first domino is back to December 31st, basically January 2021. Three Arrows Capital and the GBTC premium. Let's talk about this. And I think it begins with the SEC, our cop on the beat. We're looking at an SEC filing for the Greyscale Bitcoin Trust for this product called GBTC. Why are we looking at this? Why does our story start here?
So this is actually a filing by Three Arrows Capital at the start of 2021. And if you scroll down, you'll see that Three Arrows Capital is declaring that they have become an owner of 6.1% of the total GBTC supply, as in they own 6.1% of the trust. How did they get 6.1% of the GBTC trust?
They bought it, right?
They put up some money,
okay,
but not with Greyscale. They had some money. They had investors. Three Arrows Capital got investors somewhere. They probably put up some of their own money. And what did they do? They gave that money to Genesis as collateral to borrow Bitcoins, because they could take those Bitcoins, because at this moment in time, Ryan, the GBTC, like I said, it doesn't trade one-to-one. It's not equivalent to one Bitcoin. It is at a premium or at a discount to Bitcoin based off of the net present value of all the assets in the trust. And so for a long time, GBTC traded at a significant premium to actual Bitcoin. And so what could you do? You could take one Bitcoin, you could deposit it into the trust. 6 months later, you could receive and redeem a GBTC share, which had a premium associated with it versus the Bitcoin that you deposited. And then you could sell that premium and pocket that arbitrage.
Okay.
Make sense so far?
This is an arbitrage opportunity for Three Arrows Capital, and it seems like a riskless arbitrage opportunity, right? And
with 6 months of time, but yes.
The context of this is Three Arrows Capital just made a boatload of money in DeFi Summer and all of the yield products and degenning away over there. And now they're like, where's our next hit going to come from? And they're seeing this big, juicy ARB opportunity in between the spot price of Bitcoin and GBTC. And by the way, they're the only ones that can kind of access this. And when I say the only ones, I mean large institutions like Three Arrows Capital are the only ones, because retail investors cannot buy this product
Right.
from groups like Grayscale, OTC, over the counter. That is,
They cannot produce this arbitrage.
they cannot
They can
produce this
only
arbitrage.
buy GBTC
Secondary.
on the secondary market. Right.
Got
They
it,
cannot
got it.
mint new GBTCs.
Okay, so Suzu, Kyle Davies are like licking their lips. Here's another arbitrage opportunity. That's what our fund is set up to do: is make money through Arrows Capital. It goes in and buys 6%
Right.
of this product.
But it's not like they just come in and like ape into 6.1%. What do? They take whatever winnings they got throughout 2020 and 2019.
Yes.
And I mean, you know, starting at February 2020 after the COVID crash, it was up only from there. So if you were in at February 2020, you're making money. Especially DeFi summer was probably the most lucrative time in the last like 3 years.
Okay.
And so Three Arrows Capital takes all their money and they gives it not to Greyscale but to Genesis. They put up their capital in Genesis as collateral, and they buy as many bitcoins borrow as many bitcoins as possible, and they take it and they give it back to Greyscale to produce GBTC.
So they're buying this on margin.
They are borrowing bitcoins on margin from Genesis. However, the thing that is crazy is that Greyscale and Genesis again are both under Digital Currency Group. And so, hang on, let me open up a document to make sure I get this right. Since they are both owned by Digital Currency Group, there's this unique position that Genesis has, because Genesis is the only authorized participant, aka in crypto native speak, the only party that can mint and burn shares of GBTC. So when Three Arrows Capital borrows Bitcoin from Genesis, they were actually giving it straight back around to Genesis, because Genesis is the one that's minting GBTC in the first place. And so it's this very incestuous relationship between Genesis and Greyscale that is the linchpin of this whole thing, and why there's so much contagion. Because what Genesis would do is they would just like, hey, Greyscale, come put up capital, and then have this free arbitrage opportunity. And why is Genesis incentivized for this? Well, when you can take, and Genesis is like giving out people for depositing their Bitcoins, they're giving them a yield, Gemini Earn, for example. If you come and deposit your Bitcoin in Gemini Earn, Gemini gives it to...
That's how it flows down to retail.
That's how it flows down to retail,
access
right?
to these yields.
So retail gives their Bitcoins to Gemini Earn. Gemini Earn pays retail a yield. Gemini gives that Bitcoin to Genesis. Genesis pays Gemini an Earn. Gemini takes a percentage, passes that on to retail. Genesis allows Three Arrows Capital to take that Bitcoin and then convert it into GBTC through their sister subsidiary company, Greyscale. And the thing is, when that happens, Greyscale takes 2.5% yearly fees of all assets under management. And so there is this huge question as, what are the incentives of Genesis? Why does Genesis, think about this, like as a system, part of this overall system, it's Digital Currency Group. Digital Currency Group makes more money the more assets are under Greyscale's management. So if Genesis can get all of the Bitcoins into Grayscale, that means
it's a revenue engine.
It's a revenue engine, right? And so all Genesis has to do is create this arbitrage opportunity that allows people like Three Arrows Capital to come in and arbitrage. And so they do. And so Three Arrows Capital milked the absolute F out of this premium. And so at some point in the early 2021, that premium, which is what we're looking at here, it's all premium. And you can, like, all of that premium on the left half
opportunity,
is the arbitrage opportunity. At some point in very early 2021, it gets milked and the premium goes to a discount. This is
because everyone's doing the same trade, basically.
Everyone's doing the same. Well, Three Arrows Capital is like leading this trade, but everyone starts to follow them because of how incredibly lucrative and profitable it was. And so it's actually a big problem when the premium goes to a discount, because this was, Ryan, the original yield farm. The GBTC premium arbitrage opportunity was Three Arrows Capital yield farming as much possible out of this premium. Who is buying that on the other side? It's any retail investor or anyone who's buying GBTC on the other side of the trade. And so that is who Three Arrows Capital is milking.
And retail is doing this because their money is generally, it's stuck inside a retirement account, for instance, or some sort of locked institution that doesn't have access to spot. This is not a real ETF type product. It's just a trust type product. So they kind of have to buy if they want to buy here. What are we looking at here, David? What is this chart?
Yeah, so this is this is the Barry Silbert that we talked tweet that we talked about earlier. This is when after this week we go from January to May and we have that first crash, and Barry Silbert starts to see why is Barry Silbert the one that has all this information about this daisy chain of borrowers? Because he created it. Digital Currency Group incentivized the creation of this daisy chain. That's why Barry Silbert can see it. And so when going back to like the discount versus premium on the GBTC, this was the first domino to fall, but it actually didn't cause too many problems in that moment, where all of the GBTC that Three Arrows Capital and others that held as collateral under Genesis or BlockFi or whoever, when that turned into a discount, that was bad because they start to become underwater. But at the same time, Bitcoin is up only, Ether is up only, like this part of the market is like up only. And so this is the second part of this whole like setup.
Yeah, so let's talk about that. So that's the first domino, but like Three Arrows Capital, they're feeling good right now, right? And so what do? This is the second domino to get put up there, which is Three Arrows Capital. They're taking their winnings and they're actually deploying it into crypto, and some of maybe what we might call at this point in the rotators rotation, which is what Three Arrows Capital are. They just rotate in and out of things. The blue chip assets like ETH and Bitcoin. So what are we looking at here, this tweet?
Yeah, so domino number 2 is Three Arrows Capital takes their winnings from this and they go long on Ether and Bitcoin. And then this tweet in particularly fast forward to November, where we actually skip into domino number 3, where after
November 2021.
Yeah, November 2021, where they take their Bitcoin and Ether winnings and they start to go even further out on the risk curve. And so the 2020 for them was milking the GBTC premium. That premium turns into a discount in February of 2021. So 2020 they were milking the GBTC premium. 2021 that premium turns into a discount, but they've made enough money to go long on Ether and Bitcoin. And that was the first half of the year. That was the first half of 2021. But then they start to go out on the risk curve. And so this next tweet is Three Arrows Capital leading a $230 million investment into Avalanche tokens. And so that happened on September 16th, 2021. I think that's the next link, Ryan, if you want to click that one.
Yeah.
So this is, Polychain, Three Arrows Capital lead $230 million investment into Avalanche. Importantly, Ryan, locked AVAX tokens, illiquid AVAX tokens. The next two tweets, here's Suzu being bullish on SolunaVax. And this was a tweet like hashtag that got really, really popular. And it's because they were going out on the risk curve. They were done with Ethereum and they were going on to the Ethereum killers. This next tweet is Kyle Davies being bullish on Luna. When was this next tweet? Want to click on the next tweet?
Yeah, this is from March 28th.
March 28th at the beginning of 2022, right? And so Three Arrows Capital went out on the risk curve. They borrowed a bunch of money from Genesis. They won with Ether and Bitcoin. They started to go out on the risk curve with Soluna AVAX, right? Remember all this? Remember this phase in the bull market?
Yeah. Are you guys seeing that euthanasia roller coaster of the circles getting small? Like we just went through so what's happening is Three Arrows Capital and, other degen hedge funds like them are doing similar kind of trades, but they just made a whole bunch of money on DeFi summer. They're coming in right now, they're coming back and they're using an arbitrage opportunity in GBTC, right? They're making money at the beginning of 2021 in that way. And they're going margin long, by the way. And then they're pouring that into blue chips like Bitcoin and ETH, right? And then that's not enough. They've kind of milked that. And then they rotate down the risk curve or up the risk curve, I suppose we might say, into the Soluna AVAX communities. And then by the time we get to this tweet from Kyle Davies in March of 28th, 2022, all of the previous things have not been enough. So now you could see they're getting ready to rotate into Luna. And you could just, it's so transparent because what they are doing as degen hedge fund managers, of course, is they want to, what the saying is, fill then shill. So anytime you see a Kyle Davies or a Suzu tweeting something like this, Kyle Davies goes, "Grandpa, what would the world look like when Luna was less than 3 digits?" It's less than 3 digits now, Kyle. Definitely a lot less. And he's tweeting that because he's hyping up a fill that they had previously made. And he's hyping up the Luna rotation that they're in.
But also remember, Ryan, their foundation is underwater. their GBTC collateral, which is their collateral in Genesis, is below when they bought it for. They're not insolvent.
Wow, that's right.
But
so
this
that's
whole time,
GBTC
GBTC is supporting their loans, and that they don't want to pay back because they'll take the loss on it. Yeah. So they got the dub on Bitcoin and Ether, and then they got the dub on Solana. Well, actually, they missed Solana, Avalanche, and Luna. But they need to go out on the risk curve because they don't want to sell their GBTC because it's underwater.
Yeah. Well, so far they're getting the wins, right?
So far they're getting they have one big loss because they didn't sell their GBTC, but they're still stacking wins.
Okay, and that take us to, so this tweet is March 28th of 2022. And guys, I just want you to remember that time frame we were in. It was basically like alternative layer ones were kind of kings and boss. Luna was kind of the next Ethereum killer. And people like Kyle Davies and Suzu and 3 Arrows Capital were trader gods, okay? Everybody else was wrong. All the holders were wrong. The Bitcoiners were wrong. The Ethereum people were wrong. And these were trader gods who were at the top of their game, like pristine reputation over the last couple of years of making money every single cycle. That's where we left things in March 2022. But David, we've got these 3 dominoes that I think we've kind of stacked up. And then something happens with old Jerome Powell. Around this time.
Right.
Tell us about the macro story, because if we're looking for an outside actor, the one that actually pushes these dominoes over and starts to cause the cascade that we now see up to November 2022, you have to I think Jerome Powell was the finger behind this initial push of the domino. What are we looking at here? What's the story?
So this is in February. Inflation surges 7.5% on an annual basis, up highest since 1982. And so not long after that, the Federal Reserve starts hiking interest rates. Remember that episode we did with Macro Alf, Ryan,
yes.
where interest rates and bond market volatility are at the bottom of the pyramid? Well, in the bottom of the crypto pyramid, it's all about low rates, because this bull market was a bull market on yields. We were printing free money because risk was free, and these yields were there was zero yield in the normal markets because interest rates were set to zero. But as soon as the Federal Reserve gets into the game of jacking up interest rates, that shifts the whole entire crypto pyramid, because this was a bull market on rates, on yields. And when the Federal Reserve increases interest rates, it pulls down yields from the whole rest of the stack.
This is what starts to happen. And this is the federal funds rate, a historical chart. And we could see, right? Yeah. This is what we're starting to see in April 18th. So the federal funds rate, April 18th, was about 0.33%. And of course, now we are today, about 4%, one of the fastest, steepest inclines in history on that rate. So the risk on days are over for crypto and for the cost of capital. And we are now moving to a risk off regime. Guys, this is the first part of the story. This is the part of the story where Powell tips over the first domino and the rest of them start to collapse. We're going to tell the rest of that story when we come back. But before we do, we want to thank the sponsors that made this episode possible.
Sequence is the all-in-one developer platform you need to build Web3 games and applications. For your users, Sequence is a smart wallet, and it's the easiest, most intuitive onboarding your users will ever experience, and comes with all the features users need to feel empowered in the Web3 world. Multi-chain support, NFT display, and users can buy SFTs, NFTs, and crypto directly with a credit or debit card. For developers, Sequence is the plug-and-play platform for Web3 games and apps. Their APIs let you bring NFTs, SFTs, and tokens into your game or application. And a Sequence relayer enables gasless transactions for your users. Sequence already powers some of the best Web3 games like Skyweaver, NFT projects like Cool Cats, and marketplaces like NiftySwap. And Sequence is compatible with all the EVM chains, including Ethereum, Polygon, Binance Smart Chain, Arbitrum, Optimism, and Avalanche. So go to sequence.xyz to get started unlocking the full potential of your application today. The reality today is that 5 corporations control the entire world of social media. They own our names, they restrict our content, they monitor our every move. And their time is up, thanks to our sponsor, DESO. DESO is a layer 1 blockchain built from the ground up to decentralize and scale social networks. With DESO, you can own your own identity, content, and social graph, and take it with you across hundreds of applications already built on the censorship-resistant DESO blockchain. DESO's storage advantages make it finally possible to build infinite state applications applications that can efficiently store and index large amounts of content and data fully on-chain. DESO also offers multiple crypto-native monetization primitives for developers and creators, including social NFTs, social DAOs, social tokens, and social tipping. So in order to experience the social layer of Web3, go to DESO.com and claim your username. That's DESO.com. TRUEFI is DeFi's largest credit protocol, connecting global lenders with institutional-grade lending opportunities. TRUEFI has completed over $1.7 billion in originations and paid out nearly $35 million to lenders, proving that DeFi is ready to take its next big leap into the $8 trillion credit market. TRUEFI gives lenders like you access to sustainable, high-yield opportunities backed by real-world investments, usually reserved for high-net-worth individuals. At the same time, fund managers use TRUEFI's financial infrastructure to bring their portfolios on-chain, benefiting from the global liquidity, cost savings, and transparency of DeFi. TRUEFI is a decentralized financial utility. The protocol is owned and governed by the TRUEFI DAO, and TRUEFI is here to bring DeFi into the golden age, bridging the power and access of crypto with institutional-grade lending opportunities and portfolio tooling. Explore the diverse financial opportunities available on TRUEFI or launch your own portfolio at TRUEFI.io. And of course, Terra is the first domino to fall. An unbacked algorithmic stablecoin. Of course it is. Of course it is. The most risky thing. A stablecoin with nothing behind it. But first, before it falls, they have to prop up their reserves, right? And so this is coming in, when was this? April 7th. Terra buys $200 million of AVAX tokens to bolster their reserves beyond Bitcoin. An interesting choice because of how illiquid and non-collateral-like AVAX was. On May 5th, the Luna Foundation Guard, if you guys remember that, buys $1.5 billion in Bitcoin. $500 million of that came from 3 Arrows Capital, and it would be later revealed, Ryan, that $200 million of that purchase that got sent from Luna to 3 Arrows Capital, $200 million of that was UST. UST, of course, went to zero. And so
Genesis bought that.
3 Arrows Capital.
Capital bought that.
Genesis did an OTC swap, and they also did an OTC swap with 3 Arrows Capital. 3 Arrows Capital, out of the $500 million of Bitcoin that 3 Arrows Capital sold to the Luna Guard Foundation, 3 Arrows Capital agreed to take $200 million as UST for compensation for that. Now remember,
look at this. The OTC swap includes 1 billion UST for 1 billion worth of Bitcoin. Imagine trading UST, which is on its way towards zero, just people don't know it yet, for 1 billion worth of real assets, which is Bitcoin.
And then it actually, and so people, this was the event that actually triggered the collapse of UST, where UST liquidity was sold off for Bitcoin. And so there was not much to prop up. There was not much liquidity left to prop up UST. And so this happened on May 5th. May 5th, Luna Foundation Guard buys $1.5 billion of Bitcoin. May 13th, Luna UST collapses. So just 8 days later. And this was also, Ryan, the beginning of the end for FTX. So if you want to go to the next link, this is where the contagion really starts to hit. And this was an article out of Decrypt that had a ton of analysis from Nansen. Nansen has been going on chain trying to track all the money that happened as a result of this. And so in $4 billion, this is when $4 billion in FTT token tracked from Alameda to FTX aligns with the report of FTX loans to Alameda using customers' funds. And so this is where the House of Sam enters the story, and the House of Alameda and the second hedge fund to trigger a bunch of contagion enters the game.
Okay, so where are we in the story? So we've got the fourth domino, which is the collapse of Terra. Now that has tipped over. Again, Powell is kind of the finger at the one end of the dominoes. That tips over. And by this point in the story, has 3 Arrows Capital gone under yet?
They are about to. I'm so happy you asked.
They are about to. Is that what's next?
Yeah, so I would say like domino number 5, if we want to add on dominoes, Ether and Bitcoin are about 50% off of their highs in this present moment, right?
Okay.
This is when you and I are doing a bunch of macro shows. We're understanding interest rates. We're understanding inflation. Everyone's kind of learning about interest rates for the first time. Ether peaked out at $4,800. Bitcoin peaked out at $69,000. And by this moment, right at the end of that red square, Ryan, which goes from about middle of November to the start of June, was all of that. Like this was pre-Terra Luna collapse. And so pre-Terra Luna collapse, Bitcoin and Ether are 50% off of their, excuse me, about 60% off of their highs. And that is the collateral base for Three Arrows Capital, for Alameda. But not only that, because Solunavax, which I think is at the next link. No, it's not. It's just like, this is Suzu just talking about the super cycle, right? So Luna AVAX, which was the other collateral base for Three Arrows Capital, is off 80% off its highs.
No way.
In this moment, before the Terra Luna collapse happens. So at this moment, Three Arrows Capital is in an extremely tough spot. So if you're in a tough spot, Ryan, as a hedge fund with a bunch of illiquid collateral that you can't sell, what do? Do you
narrative
call it quits?
spin, my friend? Narrative spin, and
you also borrow from any lender that will give you money. You also forge documents and defraud investors to give you more capital so that you don't have to sell anything, because Suzu and Kyle Davies were so goddamn delusional that they were doing the whole super cycle thing that the entire industry fell for. So they were pounding their super cycle chess while they had.
What is the super cycle for people who don't know?
The super cycle, Ryan, was the cycle of crypto that we get 2 cycles instead of just 1. And so while it might have felt like we were off on at the end of one cycle, we were actually going to go on and begin a second bull cycle. That was the narrative that Three Arrows Capital led. And they needed that narrative to be true because they were locked up in illiquid shitcoins.
Basically, the way I remember it is, you know, we've always had boom and bust cycles in crypto, like forever, right? And so the narrative around the super cycle was like, those days are over. Now we're mainstream. Right. Now we have like suits, we have like FTX, we have Wall Street here, and so that's not going to happen anymore. We've matured, and so we'll get blips down, but gone are the days where you see a down 83% Bitcoin. Like that was last cycle stuff. Gone are the days where you have Ether off 90% all-time highs, right? This is kind of a new era. And boy, were they wrong. They got a lot of people on that, though.
Yep.
You know, would you count yourself among one of the people that was kind of seduced by the super cycle?
Yeah, dude, it was
idea?
Intoxicating. The super cycle idea was super intoxicating. It's like, oh yeah, like the one cycle to rule them all. Like, yeah, I'm on board with that.
Sounds nice,
right? And so like that turned out to like start to become threatened, right? And this is where Three Arrows Capital started to increase the level of contagion that they had. They borrowed from anyone that would ever give them money, like the big lending desks like BlockFi and Genesis, down to like the C tier lending desks that would give them any amount of money, down to the money that they stole from people that traded on their accounts, right? So this is one of the, rather than becoming humble and selling for a loss, they doubled down, they borrowed as much money as possible, and they increased the amount of contagion in the system. And that was just as a result of the Terra Luna collapse, which was a big part of their position. But that was just the start of it. Yeah, let's see, where are we at? Where are we at here? Okay, so this was in June 1st. Interestingly, June 1st, while the whole entire industry is on fire, FTX passes Coinbase in market share, while the next day Gemini lays off 10% of its staff to prep for winter. So FTX somehow doing great, yet Coinbase starts to beat Coinbase in market share, and while in contrast, Gemini is starting to laying off people. And this is when you and I, when we were reporting on the Thursday weekly or the Friday weekly roll-up, you're like, yeah, FTX is coming to save the day. FTX is just like this huge story of just like success.
Well, it seemed like it basically seemed like, okay, so at this point in the story, we were at what, like June or so?
June of 2022.
And there was contagion, right? Obviously, from the Terra Luna collapse, and Three Arrows Capital went completely down. A whole bunch of other funds were completely wiped by this whole mess. And what it looked like is the exchanges and the funds left standing were the ones that were responsible with their funds. Yeah. They were the ones that made it through the storm and came out stronger. And Alameda was among those. Look at FTX is like surging on the back of this relative to Coinbase, whereas Gemini is like laying off 10% of its staff. So it looks like there's a changing of the guards here. If the move fast kind of exchanges and funds are the ones that have made it out, but that was all a facade. as we later learned. But what's this tweet from Greyscale here?
Yeah, so we're going to take a quick rabbit hole here because in this moment, Greyscale had previously, Greyscale, yes, they hired this guy, Donald B. Verrilli, who's a former Solicitor General of the United States, as an legal counsel, and they put a thread together as to why. And basically, if you just want to skip forward to the Jake Travinsky tweet, Jake is, oh, I guess I didn't put that in.
I don't know if I have that.
Basically, I'll just read it out because I have it in front of me. Somebody asked, hey, Jake, just to check my reasoning on this, they are hiring this individual because they want to sue the SEC when in a few days the Greyscale request to turn the GBTC trust into an ETF. Well, the SEC has to give an answer in like 2 or 3 days, and Greyscale is predicting that the SEC is going to give them a no. So they are hiring this legal counsel to take them to the Supreme Court. And Jake Travinsky is like, yeah, this is exactly what they're doing.
Okay, but so Greyscale wants to convert their GDBC product to a real ETF, right?
Yes.
It's like kind of Pinocchio wants to become a real boy,
Yep.
and this trust product is not a real ETF, and they want to convert it to a real ETF. By the way, that would be great, wouldn't it? Because this would be a more capital efficient, retail friendly product, and their retail is already buying these trust products, which are trading off of like NAV, are not like necessarily, you're getting ripped off. Potentially, if you're buying this product, you don't know how, it's just trading off the spot market price of Bitcoin and ETH. And so they want to convert this. So the entire industry is cheering them on. Is there some other ulterior motive towards converting this? Or do you think this is a real sort of pure motive from Greyscale saying, just like, let's make this thing an ETF? What would that solve for the kind of Contagion story here?
The timing of this is really interesting because in this present moment, GBTC is the collateral for Three Arrows Capital and so many others in this space. Smaller people that, we don't say their names because they're just not as big as Three Arrows Capital. But GBTC is the collateral that is backstopping a lot of these loans. Also, the loans coming out of Genesis, a big player here. In this moment, when is this? June 7th of 2022, the discount on GBTC is negative 30%, as in there is 30% of Bitcoin collateral that is not being accounted for because it's not an ETF. As in, anyone that is using GBTC as collateral is only accessing 70% of the total potential collateral that is there in Bitcoin, but they aren't able to tap into all of that collateral because of the discount on the GBTC trust because it's not an ETF. And so
that's a lot of problem if you're using GBTC as your margin, as your collateral source for a loan that you take against it.
It's a huge problem, right? I mean, like, you cannot have the GBTC price go down, especially when Bitcoin is going down, but the GBTC token price is going down even more than that, right? So like in January when Bitcoin was like $69,000, then moving forward into July, it was something like $25,000. That's bad. But the GBTC price went from above 30 to negative 30%. So it had an additional negative 60% move versus Bitcoin. And so Greyscale is preparing to sue the SEC to get the Greyscale GBT trust to turn into an ETF and fix this discount that is sucking up so much capital out of the industry. Anyways, we'll come back to that later. First, we have to get to this first round of Contagion. So a bunch of dominoes have started to fall. The BlockFi valuation goes from $4 or $5 billion down to just, $1 billion in their attempted raise in June 7th. That $1 billion valuation does not last. And let's see, what's the next one? And then as a result of this, and this is the middle of Three Arrows Capital, this is the title out of CoinDesk. Three Arrows Capital faces possible insolvency after unforeseen liquidations, right? And so this is Terra Luna going to zero. This is their Ether and Bitcoin like losing 60%. They have locked Avalanche tokens. If they were in Phantom, that thing's at zero. And so they don't have any money left. And so they are getting liquidated because they borrowed all this money to backstop any of their loans so they couldn't have to sell. But then the final nail in the coffin, which is Terra Luna, collapses and they start to get liquidated. BlockFi
liquidated them as well. One of the others that liquidated them.
So let's say, lingering on that for a moment, it's actually unknown how big of a hole Three Arrows Capital left in BlockFi. But this is definitely when the BlockFi troubles start. So Three Arrows Capital gets liquidated by BlockFi. At the same time, BlockFi becomes significantly insolvent.
Well, it's the story of this, like at the far end, at the tail of this human centipede of like greed and yield is like retail.
Yep.
Which is like if you wonder where, not in all accounts, but like say for example BlockFi, how is it generating the yield on ETH and BTC? It's this whole process of arbitrage between GBTC and Bitcoin and large funds and Genesis. They're all kind of tied up in this, and retail is kind of like just downstream of these yield. They just get a smaller cut than the big guys, right? So Three Arrows Capital is making a lot of money on this arbitrage, and this shows up in like maybe a 3 to 4% yield in BlockFi at the other side of this. But when that opportunity goes away, the yield goes away too. And so does some of the margin that has been kind of protected against this. The same story with Voyager.
Before you move on, Ryan, in that article right there, there's a line here that says a substantial amount of the Bitcoin that customers deposited at BlockFi was directed to GBTC or Three Arrows Capital. As a result, a large number of BlockFi's Bitcoins are illiquid. So where was, in addition for Three Arrows Capital was paying BlockFi to borrow from them, BlockFi was also taking customer funds and working the GBTC premium just like everyone else. But they could, once the net asset value went negative, they couldn't redeem that because it was underwater. So not only Three Arrows Capital needed the trust to turn into an ETF, BlockFi also needed that too. They were doing the same thing that Three Arrows Capital was. So here's a Voyager. Of course, we all remember Voyager gave Three Arrows Capital an uncollateralized $660 million loan. So that's not bad. So that went to zero. But then Alameda comes in with $200 million in cash and a USDC revolver, with $200 million in USDC as a line of credit, along with 15,000 BTC intended to help Voyager meet customer needs during this liquidity
good
crunch.
old Alameda.
Thank you, Alameda, saving the day.
And that's why at this point in the cycle, you were like, well, if Alameda's bailing companies out, like they must be doing okay.
Right.
They must have cash while everyone else is like underwater. And so that seemed to be bullish for Sam's empire and the house of Sam Coin here.
And you know, that's the first of two. FTX also backstops BlockFi to keep them solvent. So BlockFi valuation drops down to as low as $25 million after being as high as $5 billion just a year prior. And FTX gives BlockFi a $4 million line of credit to keep customers liquid. And the quote from this article, FTX CEO Sam Bankman-Fried has been seen as the lender of last resort in the space. In addition to BlockFi, Sam Bankman-Fried's company Alameda Research also provided a $5 million loan to Voyager. So this is where SBF really like rose and saved the day. Like everyone else was insolvent, FTX seemed to be the one solvent one in the room, and he just bought up and backstopped the entire industry. Turns out that was not the case. Turns out that he was not the lender of last resort. That turned out to be Genesis, which we'll get there. This is the Zach Prince's thread very happily announcing that he was going to be able to restore customer deposits thanks to FTX.
That was really a lifeline at that time.
It was a lifeline.
It would have gone under without it.
Meanwhile, the dominoes continue to fall. Three Arrows Capital files for bankruptcy in the British Virgin Isles. This was announced on July 1st. On July 18th, Genesis was discovered to have lent $2.36 billion to Three Arrows Capital using only an 80% collateral margin requirement. And so 20% of $2.4 billion, that hurts. And of course, they are seeking repayment of the outstanding debt through arbitration in New York. A spokesperson for DCG told the block that both DCG and Genesis balance sheets remain strong, with no remaining exposure to Three Arrows Capital. Genesis continues to be well capitalized, and its operations are business as usual. That might have been true. Here's Michael Morrow, which I found this tweet while I was staying up super late.
Who's this guy?
He is at DCG, former CEO of Genesis Trading. I found this tweet which says, "Since then, we worked with DCG to find the optimal strategy to further isolate the risk. DCG has assumed certain liabilities of Genesis related to this counterparty," that's Three Arrows Capital, "to ensure we have the capital to operate and scale our business for the long term." Basically, DCG bailed out Genesis. And that's where one of the big holes in Genesis comes to be, or DCG as a whole.
So much was going on in July that I don't think I really noticed this so much, right? We were all like,
We
okay,
didn't know what
Terra
it
Luna
means.
blew up, Thera's Capital blew up. Is retail going to be okay? Celsius, we missed Celsius, but of course they were long gone
Yeah,
by
Celsius.
July.
I actually went through this agenda and deleted all the Celsius mentions because they just went under their own steam.
Yeah.
They actually didn't have any contagion.
You can't even blame anybody like on the institute. It was just Alex Mashinsky was like
It's
degen
just being
gambling
an
with
idiot.
company
Yeah.
funds.
Uh-huh.
Okay. And then what's this?
And this is
There's
the summary, right? July 22nd, Suzu says that Terra and GBTC led to Three Arrows Capital insolvency.
This is like their retrospective
Yep.
interview, right? It's like, why did things go wrong? And they point to what? GDBC trades?
Yeah, GBTC and
Terra.
Terra Luna as the big ones. But of course, they never sold. They never took profits. They were up only. It was a super cycle. And yeah, they just got, they Icarus too hard.
So I think we're Domino 5 now. That has fallen, all right? And this is where
so things are like starting to like settle out. The dust is starting to settle. And we're like, was that the bottom? Like, are we just crab market from here?
It felt really bottomy.
It felt very bottomy.
Wait, was it in July or was it later in August?
It was the end of July when things started to calm down and we didn't really make new lows.
Prices were low. Like ETH price was down to like new lows. Did it spike down to 800?
850 was the low, but that was in like July or June or something.
Yeah. So that's where we are. Okay. So now Domino 6. Enter FTX. The FTX fraud, which we have now uncovered, which people didn't know about at the time. Nobody knew about this, but there is some, I guess, records, some things on the blockchain because, of course, all of your transactions, all of your fraud is when you put it on chain, it's always on chain. This is from Nansen. I think you have some like maybe stats to read out about FTX and some of the things that they were tracking retrospectively. This is a report they put out last week. It sounds
recently.
like.
Yes.
Okay, tell me about this.
Okay, so 3 big transactions. On the 12th of May, FTX transferred 90,000 Ether, $211 million, and 6.8 million FTT tokens, $224 million, to Alameda. The Alameda address 0x780, which was then transferred to Genesis. That same day, FTX sent another 155,000 Ether, $320 million, to Alameda, which then eventually was transferred to Genesis once more. May 26th of this year, FTX sent 3.5 million FTT tokens, $103 million, to Alameda Research, which was eventually transferred to Genesis once more. This was in May.
I notice all of these transfers are only going in one direction, and this is FTX to Alameda, not the other way around.
And then Alameda to Genesis.
Why to Genesis?
Because Alameda had loans from Genesis that they needed to
collateralize.
They were about to be margin called. This was the FTX bailout. This is how FTX plugged the hole temporarily. The whole industry was just like gushing, flesh wound. And FTX and Sam Bankman-Fried says, I know what can plug that hole. FTT tokens.
Is it FTT tokens?
Yes.
These are all FTT
it's a bunch of Ether and also FTT tokens.
Okay, where's that Ether coming from?
Those are probably customer deposits, Ryan. Those are the customer deposits.
Yeah. So Alameda gets a hole blown in it, like a bazooka hole, and then Sam is doing the thing where like, here's the Band-Aid over that, and what am I going to do? FTT tokens, which is basically a valueless token that I can mint and have unlimited access to, and then depositor funds. Very likely through
probably investor money too, like wherever they could get their hands on. So like the big question was, where did Alameda get all the money to be able to bail out the industry? And the same rules to answer this question apply to where Three Arrows Capital got their money to try and plug their holes when they were underwater right before Terra collapsed, which was wherever they could get their hands onto cash. Customer deposits on FTX, which Sam made sure that he was able to do with that custom backdoor.
In the accounting system.
In the accounting system. They also minted funny money, FTT, that they use as collateral to borrow from anyone who would take it, regardless of its liquidity profile. Genesis then took that FTT as collateral, and the $2 billion that they raised from investor money. So this was the capital that FTX and Alameda were using to plug the holes of the Luna collapse.
Is it very strange to you that Genesis is using all of these weird, like, funny money tokens as collateral? Like, to me, I would be weird. Like, my collateral is dollars, it's Bitcoin, and it's ETH.
Yep.
Anything else, I don't even know about.
Yep.
Like, don't even come to me with your FTT tokens. I wouldn't accept that as collateral. I guess they thought that maybe they hedged against these things.
Yep.
But of course they didn't. Is this where do we go to next?
Yeah, so this is just a summary. Genesis received over $1 billion of FTT tokens from Alameda and FTX within the last 3 months. Surprisingly, the whole in Genesis is about $1 billion. Weird.
Meanwhile, on the SEC side versus Greyscale, what are we looking at here? What's the House of Gary Gensler doing at the SEC?
Yeah, so this is the June 29th announcement that Greyscale initiates a lawsuit against the SEC because the SEC denied their request to turn the GBTC trust into an ETF. And so in this thread, they say, through the ETF application review process, we believe American investors overwhelmingly voice a desire to see GBTC convert to a spot Bitcoin ETF, which would unlock $1 billion of investor capital while bringing the world's largest Bitcoin fund further into the U.S. regulatory perimeter. The SEC is failing to apply consistent treatment to similar investment vehicles and is therefore acting arbitrarily and capriciously in violation of the Administration Procedure Act and Securities Exchange Act of 1934. Why? The timing of this, to me, Ryan, is really interesting. I think, because you know how we started this whole thing with Barry Silbert saying, hey, there's a daisy chain of borrowers and lenders. Some are capitalized, some are not.
Yeah.
The timing of this, when is they sue the SEC, the moment that the industry needs the GBTC trust to convert to an ETF the most.
Oh, right.
The thing that would bail out most of the industry and would actually plug the hole rather than a liquid exchange tokens like FTT would be the unlocking of all the capital that is lost
because right
of the
now
trust.
GDBC is way underwater. It's
way underwater.
Trading at a massive discount to NAV, and what's happening is this is making all of the collateral on Genesis basically underwater.
Yep. And
it is kind of like rocking the entire foundations of this crypto lending and borrowing institutional market. And Sean and Shine here is maybe it's like, obviously the whole crypto industry can get around this because we want a ETF product rather than having trust products, but also selfishly they kind of need it to bail out Genesis and all of the large institutions that are kind of underwater on their GDBC collateral and ETH collateral. Is that right? Yeah,
that's right. Meanwhile, what's the SEC doing? Charging Kim Kardashian for touting crypto securities. That's what, in this same time frame, that's what the SEC was up to. Going after Kim Kardashian.
Do you think Gensler's playing 4D chess here, where he like knows how much pain the crypto industry is in, and is like, I'm not doing this right now. I'll just let you guys get crushed.
The conspiracy hat is on right now, man. Like,
who knew about this?
This whole thing seems like Gary Gensler's like, hey, if I don't allow for the GBTC trust to convert to an ETF, the whole crypto thing will like the whole.
You think he knew that? I don't know.
He probably didn't. But man, is it just like the scripting on this is insane, man.
Yeah, the script writers have outdone themselves in season 2022 of crypto. All right, so that's the 6th domino, and then the 7th domino is when we start to see the fraud.
Yes.
This is the most recent domino to follow, and this takes us to, I think, like maybe 3 weeks before that domino fell. So right now we're in October. We're like, oh, that was tough. Wow.
Glad that's over.
Glad that's over. We had all of the like underwater funds. They're out of here. The algo stable coins are out of here. Now we have the players that are remaining, which is like Binance, Coinbase, the responsible exchanges, the responsible funds like Alameda. Good job, guys. You're bailing people out. Thank you so much. Oh, and FTX, of course. Tom Brady supports you.
So thankful.
You're still here. And then Sam starts to weigh in. This is Sam Bankman-Fried on crypto regulation. That's where we're picking up the story with domino number 7. So this is the famous tweet thread on his current thoughts on crypto regulation.
Yeah, and this is, of course, where a lot of people started to pay attention to Sam Bankman-Fried. What's he doing over there? And of course, the FTX blog, Possible Digital Asset Industry Standards. I thought DC Investor had a pretty good take, which I put next, which was SBF is the most effective value extractor in crypto. He's very transparent in that he wants to siphon value out of your account into whatever causes he claims to care about. Couldn't care less about decentralization. Meanwhile, NPCs and simps worship him like a hero. This was in October 19th, Ryan. This was before all the people we all realized that FTX was insolvent.
What's interesting is when I saw this tweet from DC Investor, and of course, like silently, I'm nodding my head, being like, "This could very well be true. This is probably true." And yet, you want to give people the benefit of the doubt, right? And so, how do you steelman Sam Bankman-Fried's argument around regulation?
Right.
So, DC. October 19th is painting him as a pure villain, and that was not at all clear at the time that he was. Of course, he turned out to be.
I think that the wording "siphoning money out of your account," it's just like so prescient, man. Like that's exactly what happened. And remember how I said, like, when 3 Arrows Capital went under, the last thing that they did was they maxed out the contagion of the system. They were underwater on GBTC. They were down bad on Bitcoin and ETH. They were down even worse on Soluna AVAX. And so while they
money from wherever,
borrow money from
even
wherever
from
you can get, like unsecured from Voyager, BlockFi, like investors, wherever you can get, like forged documents, so you don't have to sell.
Well, so Sam was like, when this recovers, I'll pay all the depositors back.
Oh,
I mean, like, that's true. It wasn't a long-term plan to just be in a constant state of like not having a one-to-one backing of all of the Bitcoin and ETH on these exchanges. This is kind of the gambler's play. When you're down bad, you borrow and then double down some more.
Right. And so, yeah, this is the exact same. There's like the through line between SBF and 3 Arrows Capital was that in their last moments, they levered up instead of levering down. Instead of saying sorry,
we screwed up, but we don't want to make it worse. They just were trying to save.
Their egos got in the way. They loved their personalities, and they refused to take the L. It was wins. It was going to be a win or destruction. And that is the commonality between both of these parties. And as a result of their ego, Ryan, they made choices that maxed out the contagion in the system, which we are now feeling to its massive effect today, but we're still not there yet.
Okay, so this is FTX. At this point in time, and Sam was, weighing in on crypto regulation as if everything in his house was like fully in order, and he's just helping the crypto industry have a seat at the table with regulators. Meanwhile, this was the first big report that came out of CoinDesk, right? And so many dismissed it as FUD, as fear, uncertainty, and doubt at the time. But this report really revealed that Alameda and FTX were kind of interlinked. And the balance sheet between these organizations was not looking too healthy. That came out on November the 2nd.
This is because what happened was that all the real money, the USDC, the Ether, the Bitcoin in FTX, was paid back to all their margin calls, and all they had left was FTT. And so they were minting FTT to backstop Alameda. And this was also when like a lot of the confusion as to like, all right, where's the line between Alameda and FTX? I don't really know. They're just like swapping FTT tokens between each other. And so CZ, as a result of this report and a bunch of on-chain analysis, I'm sure, realizes that he's like the last big bag holder of FTT that is where FTT is being used as collateral everywhere. And so CZ is like, well, I'm not going to be like SBF's like
exit liquidity,
right? Like he's going to be my exit liquidity. So if he's going to do this to me, no, I'm going to front run him. I'm going to dump all of my FTT because I'm not going to be holding the bag very publicly, right? And so because Binance invested in FTX, they had a bunch of FTT tokens. And so at once this report that came out that showed that FTT was being used across the SAM universe as collateral for all of these loans, he's like, well, that puts FTT in an extremely precarious position. I would like to actually cash in on my investment into FTX before it goes to zero. And so I'm going to start selling. And that is where the FTX empire gets punctured. Here he is like tweeting out like, here's me moving to almost $600 million of FTT tokens to move to Binance. And then I really like this next tweet, which of course CZ retweeted. Let's be clear, Binance did not define SBF's stance on the bill that's going to regulate DeFi, or debate Eric Voorhees on the merits of FTX stance and regulation, or shitpost on Twitter, or like ruin Alameda's balance sheet, or fail to address the concerns of FTT liquidity. Basically, all of this was Sam Bankman-Fried's doing, right? This was his contagion. This was his responsibility. And then CZ really just drives the point home. 2 big lessons. Never use a token you created as collateral. Don't borrow if you're going to run a crypto business, don't use capital efficiently, have a large reserves. And then Binance has never used BNB for collateral. We have never taken on debt.
This is the striking point of this was November 9th when we realized we were first realizing that there was an absolutely massive hole in FTX and Alameda balance sheet, and it just struck me because out of that original regulatory post that Sam Bankman-Fried laid out, we actually invited him onto Bankless to have a debate with Eric Voorhees on the merits and the path forward for crypto regulation. And of course, you guys will remember SBF was giving the case for why DeFi should be much more harshly regulated, including DeFi front ends. And he was saying that if we don't do this, far worse things will happen. This debate was going on in the midst of a $10 to $16 billion hole on the FTX and Alameda balance sheet. Well, this guy in the background knows he has tried to cover the Alameda hole by taking depositors' funds from this exchange, and he has the audacity to argue for greater DeFi, regulation. It was just an incredibly bizarre, episode to have happened. And I tweeted this 11 days ago. We hosted a debate in crypto values with a billionaire who was secretly gambling away billions of dollars of depositors' funds. This guy was lecturing us, David, on crypto regulation while committing the biggest fraud in crypto history.
That same day, he finds out that FTX tapped into customer funds to try and plug its $10 billion hole. Well, that was actually where it created the hole. Crazy timeline. Back to the SEC. Resume that rabbit hole. Here's a tweet that I really liked. By failing to create an ETF for Bitcoin, the SEC, one, allowed the Greyscale GBTC trade to rip retail investors for 5+ years. It's created the GBTC negative premium, forced most crypto trading outside of the US jurisdiction, and let FTX's fraud hit millions of Americans it shouldn't have. Ouch. This is where I just get on to like this simulation scripting, like conspiracy theories. Like, you could not, as the SEC, created a worse environment to protect retail investors in 2021 and 2022. They created one of the biggest reasons why the contagion was so bad is it's Three Arrows Capital's fault, it's FTX's fault, and it's also the SEC's fault.
Yeah, they certainly created the circumstances that led to this, and for kind of the arbitrage and greed and I guess closed room meetings to kind of happen, right? I mean, if we just had an ETF product from the beginning, this GDBC arbitrage would not have been there in the first place. I do think they play a role, but certainly we can't say that they are the reason that this happened to crypto.
They were a significant player.
Well, obviously the greed, the margin trading, the yield chasing, all of the things happening out of 2020 in this effort to get more and more and more, right? You can't just blame the SEC for like FTX and what Sam Bankman-Fried was doing with Alameda versus like there are so many unethical players involved in this at this point in time that it's just it's a house of actors. This was interesting too. Why'd you include this piece here, the story of Coinbase dropping its lend program?
Yeah, so Coinbase, which didn't have like an earn program with Genesis in the background, I think, and they wanted to make this lend program where you could get yield on your deposited assets, and they would get yield via their own routes, asynchronous, independent from Greyscale, from GBTC, from Genesis, but the SEC denied them. The SEC said, hey, if you guys do this lend program, we're going to sue you. And so like we had this systemic like lending desk daisy chain of borrowers and lenders that Barry Silbert talked about. And Coinbase wanted to make this onshore US regulated lending program. And the SEC said, if you guys do that, we're totally going to sue you. And so Coinbase had to drop it. It's absolutely insane. And then remember Brian Armstrong's tweet thread about like how they want to go toe to toe with the SEC. And he starts off this tweet thread as like really sketchy behavior out of the SEC. And so like, come on, like all the onshore regulated stuff we can't do, pushed it all offshore, pushed it all unregulated, allowed for the FTX fraud to happen, allowed for the Three Arrows Capital to defraud investors, and just created this extremely toxic situation outside of the jurisdiction that they were able to regulate. You're muted.
What's interesting about this though, David, is like I'm not sure why Coinbase Lend got the axe, but like Gemini's Earn program didn't, for example, and BlockFi was still able to exist, and some of the other institutional lenders were still able to exist. It does feel very arbitrary, I guess. What's this tweet showing us?
This is Colin Wilhelm. Says Gensler, who was pressed on CNBC as to why the SEC had gone after lower hanging targets in the crypto space and if he was hoodwinked by FTX after meeting with them in March. Gensler replies, building the evidence, building the facts often takes time. Okay.
This is a response to Elizabeth Warren, who, of course, this is November 9th, blamed the crypto industry for the largest collapse in history. Shows how much crypto, she says, the industry is smoke and mirrors. And Brian Armstrong replies, FTX was an offshore exchange not regulated by the SEC. And he says the problem is this, that the SEC failed to create regulatory clarity in the US. So American investors need to go offshore, as well as 95% of trading activity. Punishing US companies for this makes no sense. So regulators created a loophole for some of the big villains in this story to exploit retail anyway, by not approving things and not letting the good guys have a path forward. So now, are we here?
Now we are at present times.
Present time. Okay, so we've just sped run through all of this. We're almost here. The contagion started to feel like it was spreading beyond just the SAM FTX empire and other things. Of course, when I think my first inkling of this, there's a tweet before this, but when Gemini Earn paused their accounts, and so if you were part of Gemini Earn, you could no longer withdraw.
That happened later. So this is November 9th, this tweet that we're looking at, and Gemini Earn paused on November 16th.
Okay, so they paused November 16th. So I wasn't even paying attention to this because so much was going on and just like following Sam's tweet threads. But what is this tweet from Genesis in November 9th?
Yeah, so November 9th tweet from Genesis, and that date's important because the timeline events start to speed up. We want to provide an update on where things currently stand with our lending business. In anticipation of the extreme market volatility yesterday, we hedged and sold collateral, resulting in a loss of $7 million across all counterparties, including Alameda. So Genesis saying, hey, we took a $7 million haircut, but it was to control risk. The next day, Genesis tweets out and says, we also had $175 million in locked funds in our FTX trading account. This does not impact our market-making activities. Fast forward 6 more days, Genesis halts withdrawals in the wake of the FTX collapse. And so their lending desk is shut. Gemini Earn is now unable to facilitate customer redemptions because they use Genesis in the back end. And so getting closer and closer. And then this is Greyscale tweeting out on the 16th. So 6 days ago. In the wake of recent events, our investors should know that the safety and security of the holdings underlying Greyscale digital asset products are unaffected. This is basically saying, hey, there's Greyscale, there's Genesis, there's a firewall between these things, unlike Alameda and FTX. So I could see how you guys would get that confused. But the assets inside of Greyscale did not go to Genesis. It's actually the other way around. And this is where we come to today, or just more recent times. It's apparent from the rumor mill, we haven't really seen this confirmed, that DCG owes $1.1 billion to Genesis via an undisclosed promissory note that has been hidden from potential investors, which now indicates why Digital Currency Group is doing a $1 billion raise, which apparently that they cannot find investors for. And so this timeline of events is kind of a big oof. So November 8th, no material net credit exposure. November 9th, we lost $7 million. November 10th, oof, okay, we actually lost $175 million. November 16th, sorry, no new withdrawals. November 17th, okay, we need to borrow and raise $1 billion. November 21st, we'll go bankrupt without the money. It is now, Ryan, November 22nd. That was yesterday.
Let's start looking. Has CZ tweeted anything? Has Barry Silbert tweeted anything? Have any of these people weighed in on things?
Yeah, so Barry Silbert recently tweeted out something. I haven't had the time to look at it yet.
Should I pull that up?
Yeah.
Okay.
So that was the last 2 years.
Okay, I mean, we're gonna summarize this right now, but this looks like a very long Dear Shareholders message from Barry Silbert.
This got tweeted out about an hour ago. Yeah.
Tweeted out an hour ago. That brings us to the current time. So current time, what everyone wants to know is is Genesis going under, right? Is GDBC backed? All the Greyscale products, is that backed by assets somewhere? And there's some kind of shakiness as to whether like GDBC and the ETH products from Greyscale are backed, and Coinbase has come out and said they're in Coinbase custody. It's all good here, but there's some like FUD going on about that. I don't know what's true and what's not. And the big question is Genesis going to get a bailout here? Are they going to be able to raise funds or not? Word on the street recently is that CZ looked at SBF's balance sheet and FTX Empire's balance sheet and said, nope, I ain't touching it. Also did so with the Barry Silbert Empire and stepped away. So now here we are. Have you, as I was talking, had a chance to scan through this letter from Barry? What's it saying?
Yeah, the line, they're basically going through a recap and saying, hey, DCG borrowed a loan from Genesis alongside of hundreds of other crypto investment firms. It's a normal thing that we did, normal business operations. And in that third big paragraph, he goes, aside from the Genesis Global Capital intercompany loans due in May 2023 and the long-term promissory note, DCG's only debt is a $350 million credit facility, a small group of lenders led by Eldridge. And so the chatter that I've heard on crypto Twitter, so while I've seen my notifications pop up, is that the Contagion is perhaps not as bad as people thought. However, I will remind people that this is a picture of text and not a verifiable on-chain view source that is DeFi. So we are still just trusting people. But right now, people seem to be like, okay, the Contagion's not so bad. But I don't think we will really know until time.
So we don't know if Genesis is going under yet. For those that have deposits in Gemini Earn, it's contingent upon what happens with Genesis. I think you're not going to have any answers until the market knows what to do with Genesis. It seems like the GDBC products and the ETH products, I mean, they're all likely fully backed by the Ether and Bitcoin behind them. And the big question is, if this is the last domino to fall, is this going to take down the digital currency group empire, the House of Barry Silbert, with it? Or is the House of Silbert going to survive another bull bear market? And what will become of Genesis? David, what kind of contagion do you think will come falling out of this? And by the way, I've seen the chat as we've been talking about this, also ask about a few other things that, like, in these types of markets, everything is in question, right?
Yep.
It's like people are saying, let's get all of our funds out of all of the exchanges. People are saying USDC is not safe. People are saying Tether's not safe. All of these other things.
Fear is everywhere.
Fear is everywhere. So, by the way, what I would say is general practice. I hope we have learned at this part in the cycle is don't keep your funds on exchanges, people.
Well, bankless for a reason.
Go bankless as soon as you can. So that goes without saying, and is at any stage in the market. Use an exchange like a public bathroom. Get in, do your stuff, get out. Okay. So that now, like, we're going to hammer that home as long as we can. But do you think this is the last domino to fall, or do you think that there are other landmines here waiting for us, like in a stable coin? God forbid Tether could it explode. What do you think about this?
Well, if we don't have as much clarity as DeFi will give us, then we just don't really know. But there's a reason why I put that pyramid structure at the very beginning, with like the pool twos at the top and Greyscale, Genesis, GBTC at the bottom. This is the epicenter, in my opinion. And this is why I started off this whole entire thing stating that I can't remember what the term for this, Ryan, is, but there's this term in musical composition where you start like a musical piece, you take the end and you place it at the beginning, and then you play the beginning, which sounds like the end. This sounds like the outro, but then it starts. So you start the whole song with the outro, and that's what it feels like is going on right now. We started this conversation talking about how Three Arrows Capital was the link between Greyscale and Genesis, and they would borrow a Bitcoin from Genesis and they would give it to Greyscale, and that would prop up the GBTC trade. The reason why the GBTC premium is negative is because so many people did this, including Three Arrows Capital. This is where Genesis started making a ton of money, and it's because they were able to facilitate these trades, but they were also able to incentivize the siphoning of money out of retail investors, out of Gemini Earn, out of FTX, out of whoever wanted to get yield. Because again, Ryan, the marker of the 2021 bull market was yield. Where did that yield end up going? Into the Greyscale Bitcoin Trust, which they could then charge 2% of the AUM as a yearly fee. And that was printing money for Digital Currency Group. And so all of this yield that we got from 10,000%, like 10,000% DeFi yield Ponzi pool 2s with stacked on top of pool 1s, stacked on top of Alameda and Three Arrows Capital, stacked on top of Gemini Earn, like all of these lending desks, BlockFi, Voyager, was stacked on top of Genesis, which was an umbilical cord to the Greyscale Bitcoin Trust. And that was the foundation of all of the yield that happened over the last 18 months. And why, Ryan, I feel like this is the foundation. This is all of that collapse, the collapse of illiquid, high-risk assets because the Federal Reserve turned on interest rates. That all of that came collapsing down, and now we're at the bottom. This is the end. You're muted.
So Genesis was the tube connecting this whole human centipede contraption together, basically. And this kind of does go back to like the dominoes, right? It turns out the dominoes were stacked, but they're kind of in a circle. I think this might be the last domino to fall in this circle. And we certainly hope that's true. But it goes back to the tweet that we started with, Barry Silbert, the prophet.
Why did Barry Silbert see this before everyone else?
2021, that summer, there's a daisy chain of borrowers and lenders in the crypto space. Some are not well capitalized, lots of leverage in the ecosystem, including some non-obvious places. Important to understand the weak links in the chain, And so that brings us to, I think, the question we started this episode with, and maybe the realization that we now have, which is like, if you look at all of the gains of 2021, and even early part of 2022, it now looks like all of those gains were a scam. What I mean is just like
2021 bull market was a Ponzi scheme, Ryan. What the hell is our industry?
Nothing real happened probably post January 2021 in terms of fundamental value and utility. And this is how markets go, by the way. This is also how 2017 happened. There was a point at which like the price of crypto, and particularly Ethereum, kind of caught up to the hype. And then after that, it was all kind of ICO raises and smoke and mirrors and nothing. Do you remember the euthanasia roller coaster? Yep. Okay. Yep. The first couple of loops feel pretty fun. They're actually valuable. By the 9th loop or so, you're dead.
Sick.
You're actually dead. G-force is killed. Well, you're dead. So you will be dumped off, right? So this is essentially how these cycles go. And it's what's interesting to me is, like, remember we started this episode trying to explain all of this with, in January 2021, what was the price of ETH? It's $1,000 right now. Well, where are we? We're back to ETH at $1,000. And that the reason I say ETH is because it's kind of like, for me anyway, it's sort of like that blue chip asset of like, it kind of is. Yeah, it's the benchmark asset for me. It's really what I denominate in, like to a lesser extent Bitcoin, but much more ETH than Bitcoin for me. And look, we've just erased all of the gains from 2021 forward. But now maybe there's some hope in that, okay? Because there was fundamental value from back from like 2016, up to now. We didn't even have DeFi in the 2018 cycle when the bull market came crashing to a halt. We were propelled into another bear market. Now we have all of this stuff. Maybe a fair price for that is around very low 4-digit ETH. Maybe that's the fair price. And we just hit the rewind button, and now we're in a rebuild phase again. That's what this is telling me as well. And so much has evaporated. But also the feeling that, like, David, I'm buying ETH this week. It's not quite triple digits, so I'm not deploying like everything, all the dry powder for that. But like, we are approaching lows. I think we're approaching the end to all of the smoke and mirrors, right?
No more pool 2s. When's the last time you heard the phrase pool 2?
Yeah, it's all gone. So wow, I guess we could have like stopped the podcast in January 2021 and then just resumed now and been okay. without all of the pain and learnings.
The other big takeaway that I've gotten from this is like one of Vitalik's takes was that he was really glad that we haven't had ETFs approved, because if we did, all of our Ponzi shenanigan games would have gone into retail investors even more. Like that's what he said. Like the world, we are as an industry not ready for an ETF because look at the games that we play.
But they still did. That's the thing, is they still did. They still found their way and squeezed in there. You can't actually plug that. There's no way to kind of plug that, because the way they found their way to retail was through like 3 steps of the human centipede. If you had to go through Genesis and then 3 Arrows Capital, and then ultimately you got your yield in Gemini Earn. So retail still found these things. So I don't even think that would have protected us. It's just, if you're playing the crypto game, right, you have to kind of protect yourself. Don't invest more than you afford to lose. Careful when you look at that yield. Where does it come from? Do you know? Look, man, crypto is volatile enough. Like, maybe don't go after yield. Stake your ETH, just hold it. There's all sorts of lessons coming out of that we've learned. But do you feel somewhat defeated? Like,
yeah, dude,
the last
like
2 years have been a waste.
Second bull market that I've been through where both of them are just gigantic Ponzi schemes. And like, is that just what crypto cycles are? Is like, we just find a new way to find a new Ponzi scheme, and then like, dude, how many times, like, the reason why
it was real until it was real until it wasn't. It was real until the end of 2020. Yep. That was all legitimate, and like, yes, we have built something real here. And then it stopped being real. And it's no mistake to me, like, there's no accident to me that we see people like Chris Berninsky like kind of check out, sometime early 2021, be like, this is stupid, this has gone too far, and start to get bearish. It's because he saw the signs of just the kind of Ponzi game smoke and mirrors that happened after that. But that doesn't mean, David, that each cycle we haven't built things that didn't exist the previous cycle and just kind of added. Like, our bottoms are lower, right? And I mean, our last bottom was 80 ETH. We're not even going to touch that this cycle. Like, look, I don't trade market, like, but like, we're not going there, not even close. So yeah,
the timing of that Molly White episode where she's like, yeah, but like what crypto brings to the table versus the harm that it creates, like, is not worth it. And
but
like,
she's going to be right. She's going to be right in the short run, but wrong in the long run, I think, is kind of the arc of critics.
So how many more cycles are Ponzi schemes versus when we actually have sustainable real world use cases? How many more Ponzi schemes?
What if it's every cycle? What if it's every cycle I've been in? I mean, it's kind of the Bitcoin fork mania.
Is that like our new branding? It's like, hey guys, come in during the bear market, stick around for the bull market, make sure that you exit at the top of the Ponzi scheme, and don't go on loops 4 through 10. Get off at loop 3 of the euthanasia roller coaster.
Oh, just dollar cost averaging the whole time, and just don't play the games, and just like back to, I remember the first Bankless post we wrote about like Bitcoin and Ether are the only assets that matter. And that was a thesis about like crypto money and value accrual in the base protocol, right? There's other assets that are going to be important as productive assets, but like those are, and I'm back to like, what am I excited about right now? It's primarily Ether. Like, I'm kind of back to that post from 2019. It's a full reset. So yeah, I guess that's the other lesson from all of this. Wow. Waste of time. I don't know what the last 2 years have been, David, but they've been something. I feel older.
I remember like getting so optimistic and just happy about like NFTs and how they were going to come and like revitalize human culture and like allow artists to like create. And like, oh, crypto's finally here. Like, we made it through the 2018 to 2020 bear market, and we're finally mainstream now. And then I look at all the shenanigans that we got up to in 2021. I'm like, dude, we are so far away.
I'm just reminded of 2 things. One thing is something that Vance Spencer said on another podcast, which is like, you measure the success from cycle to cycle, not by the peaks, but by the troughs, right? And so what's kind of the lowest point? That's the actual value. Measure trough to trough rather than peak to peak. Okay, that's the way you make sense of these markets. So that's kind of the investor tip. And the other thing is, somebody asked me earlier this week, hey, this market's pretty bad. Like the 2022 bear market is pretty bad. Like, have we ever been through something comparable? Do you still think, because they heard me say that, 2018 was still worse, do you still think 2018 was worse? And I just want to come back and say, having been through these market cycles, I think I speak for many of the veterans, is yeah, 2018 was still a whole lot worse than this.
I don't know.
And the difference,
I'll push back on that. Because,
okay, well, so let me state my case, then you can give me the pushback. The difference for me is 2018 felt like we might not make it, like we might not recover. So the difference to me was like Ether still didn't, Ethereum didn't have product market fit. Bitcoin did. I knew Bitcoin would recover, but I didn't know that there'd be a future in crypto for smart contract platforms, for anything beyond Bitcoin. And Ether was just like, I don't know, it could actually die. It might not be able to scale. It might not be like do all of these things. And so that was existential. This time, I am not at all worried about the existential risk of the core crypto assets like Ethereum, for example. And last time it was much different than that. So last time I was a little, it was much harder to press the buy button in the depths of the 2018 bear market. It is not so hard now in 2022. And that's why I kind of measure it. But yeah, what's your perspective on this? Do you think it's worse?
I 100% agree with that take. Whether or not this current bear market is worse than the 2018, so like crypto peaked at December of 2017 and it bottomed in like December of 2018. Which one was worse? Ether and Bitcoin went down way more in last bull market than this bull market.
83% for Bitcoin, 95% for ETH.
Right. And so by that measure, this bull market or this bear market's not as bad. However, in 2018, well, I guess we had ICOs, and ICOs kind of went down 99%. Maybe that was pretty damn bad.
Not just ICOs, we didn't have like people, Cardano, like all sorts of things went down that hard.
Well, Cardano came back actually. So
I did, yeah.
I did. Like Substratum, like remember those like stupid ICO tokens? Those went to zero. So maybe that was worse. But the things I don't remember in 2018 was an exchange as equivalently large as FTX go to zero and take all used customer deposits with it. Same thing with Celsius. Same thing with BlockFi. Same things with like people that attracted retail. Yes.
It's affected more like innocence.
People that owned Bitcoin and Ether, like, oh, we're only down 60% versus the 85 to 95%. But some people, Ryan, are down 100%. And a lot of them are retail.
Yes, I see. When you invest your money, like you think you're putting your money into a centralized exchange, you think that's a bank type experience.
Remember Luna, like Luna DeFi, it's great, 20% yield.
Oh no, Luna it's at DeFi, zero. I feel like is a little bit like more degen on the spectrum, but like,
but no,
FTX...
they had centralized lending to like, hey, come and just like wire us money and we'll give you like 12% yield, and that sucked them so much money out of Asia.
I see. Yeah, I get it from that perspective. So your argument is that 2022 is worse in that it impacted more kind of like, I guess, innocents. Let's just call them like people that weren't playing the pure degen game.
There was more capital destructed, certainly, because like the total crypto market.
There's way more capital destructed.
Right. And so by that measure, like this bear market has been like 2 to 4 times worse in terms of capital destroyed.
Yes, I think that's true. I think that's another way to look at it. My way of looking at it was more like, because now what's going to be, look, guys, the next, if you're listening still now, is the next few months of your life in crypto. If you're still here, if you want to be that seller, not that tourist, it's just going to be it's going to be crypto is dead, never going to recover.
Pretty boring.
FTX was the end of crypto, scam the entire industry, and this will be month after month after month coming from here, right? And so you'll feel like it really is dead. Once we get 6 more months into this, 9 more months into this, you'll feel like it's dead. And I guess the difference there, when I compare that to 2018, is like I kind of felt like maybe it was possible that the bankless future was actually going to die. This time, I know there's no effing way. I'm confident that we will recover, and we won't build back in the fragile way that we've built this industry, which is like the Genesis lending and kind of the centralized exchange and the custodian. Like we'll learn the lessons and we'll build back stronger. In 2018, I was not sure that would happen. in 2022, I sit here, even though the impact is greater in terms of total capital affected and innocence and all of these things, I am much more confident that we're going to come back, like close approaching 100% certainty. Again, look, this is just me. Again, we're going to end this episode with all the usual disclaimers, which we could be wrong. This asset class could drop to zero. Like, we could be completely wrong on all of these things, but that's the way I'm feeling versus 2018. It's much different.
Yeah, I think in 2018, can people go bankless was in question. In 2022, can people go bankless seems like the most simple and logical and justified and supported path forward. In fact, how do we build back better? It's by not doing centralized lending and doing bankless lending. So actually, I think where like previously we thought like, oh, maybe this thing won't really work. Now I'm like, this is the only way that this works.
Yeah, there's no other option. Well, that's it, guys. I hope you enjoyed the episode. David, thanks so much, man, for doing all the research to put this together and put these pieces in play. I do think that this is a really good analysis of what the heck happened the last 18 to 24 months.
I don't think anyone's actually put this full comprehensive story together. Because like we needed the DCG Greyscale piece of the puzzle to map everything together, and now we know.
Yeah, and whether whether Genesis falls or not, I think this is still like probably the last domino to fall in this. Guys, of course, thanks for hanging with us. Risks and disclaimers. Gotta remind you once again, none of this has been financial advice. This entire asset class could drop to zero. We have no idea what we're doing. ETH is risky. Crypto is risky. DeFi is risky as well. You could lose what you put in. But we are headed west. This is the frontier. It's not for everyone, but we're glad you're with us on the bankless journey. Thanks a lot.